Right now, there are tens of thousands of Ottawa families sitting on mortgages they can barely service, in suburbs that are quietly being downgraded by the same municipal debt system that built them. The city knows the number. The developers know the number. Your real estate agent has never once mentioned the number. By the end of this video, you will know exactly which 6 suburbs are sitting on a financial trap that is already closing, why 48% is not a scare tactic, but a conservative estimate based on debt load and infrastructure math, and what the people who are paying attention are quietly doing with their money right now. Hi, my name is Alexander, and this is Broken Canada. How Ottawa suburbs were built on a financial lie. Let me explain how a suburb actually gets built, because most people think a developer buys land, builds houses, and the city grows. That is the brochure version. Here is the audit version. A developer approaches the city with a proposal to build a new community on the urban fringe. The city, facing pressure to produce housing supply and expand its tax base, approves the development. Infrastructure goes in: roads, sewers, water mains, stormwater systems, parks, community centers. The cost of that infrastructure does not come from the developer's pocket in any meaningful long-term sense. It comes from a combination of development charges paid up front and municipal debt issued against future property tax revenue from the homes that will be built there. This is the part nobody explains at the open house. The infrastructure that services your suburb was paid for with borrowed money, and the repayment of that borrowed money depends entirely on your property tax bill and the property tax bills of every one of your neighbors, continuing to rise in a straight line for 30 years. The model only works if the suburb keeps growing, keeps appreciating, and keeps generating the tax revenue the debt model assumed when the bond was issued. When any one of those 3 things stops happening, the math inverts. Here is what makes 2027 the specific breaking point for Ottawa's suburban fringe. The infrastructure installed in the major suburban expansion waves of the late 1990s and the early 2000s is now approaching its replacement threshold. Roads designed for a 25-year service life. Sewer laterals installed in 1998 with a rated lifespan of 20 to 30 years. Stormwater infrastructure that was undersized from day one because the engineers were working with growth projections that assumed a real estate market that no longer exists. The City of Ottawa's own asset management reports, which are public documents that approximately nobody reads, show a capital replacement deficit that has been accumulating for over a decade. The city owes more infrastructure replacement than its current tax base can fund without either dramatic tax increases, dramatic service cuts, or both. Now layer on top of that the interest rate environment that repriced every variable rate mortgage and every home equity line of credit in Canada between 2022 and 2024. The buyers who purchased in Ottawa suburbs at peak pricing from 2021 to 2022 are now carrying mortgages at rates that were not modeled into their purchase decision. Their monthly cost has gone up, their home value has already come down from peak, and the municipal tax bill, which is the one cost in home ownership that you cannot refinance or negotiate, is scheduled to increase because the city has no other lever to pull on the infrastructure replacement deficit. This is not a prediction. This is a schedule. And the 6 suburbs I'm about to show you are the most exposed points on that schedule. The 6 suburbs and why they're exposed. Barrhaven. Barrhaven is the one I know personally, so I will start here. I will try to be fair, even though this suburb once held my mornings hostage for 45 minutes every single day, just to deposit me onto the Queensway, like a toll the city collected in time instead of money. Barrhaven sits at the southern edge of Ottawa's urban boundary. It was developed aggressively through the 2000s and pushed even harder through the 2010s. At its peak in 2021, detached homes were regularly trading above $750,000. The pitch was always the same script: new build, good schools, safe streets, affordable compared to downtown. And people bought it, literally, because the alternative was a 600 square foot condo above a downtown parking garage. So you cannot entirely blame them. What the pitch never included was the infrastructure age curve. The earliest Barrhaven subdivisions, the ones that went up in the 1990s when the community first expanded south, are now sitting at 30 years old, with aging roads and sewers. The roads in those original sections are at or past their rated replacement life. The sewer laterals are the same age. The City of Ottawa's capital budget has consistently deferred Barrhaven road and sewer rehabilitation projects, not because they are not needed, but because the funding envelope does not cover the full replacement schedule. Deferral is not a solution. It is a debt, with interest paid in deterioration. Then there is the transit problem, which is not a temporary inconvenience, but a structural failure baked into the community's design. The Barrhaven Transit Center extension was promised, delayed, revised, and repriced so many times that residents who bought with a transit-accessible future in their purchase calculation are now commuting in conditions that have gotten measurably worse since they signed. A suburb built entirely around car dependency, with no credible rapid transit alternative on the horizon, is a suburb with a shrinking buyer pool. A shrinking buyer pool means price pressure running in exactly one direction. Exposure rating, high. Deferred infrastructure, broken transit commitments, and peak-era mortgage holders make Barrhaven the most vulnerable community on this list. Kanata. It is where people go when they want to believe they are not really in the suburbs. It has a tech employment cluster. It has the Canadian Tire Center, so you can watch the Senators lose in person rather than at home, which is arguably the same experience, but with more parking and a $9 beer instead of a $4 one from your own fridge. It has retail, real amenities, and a self-contained density that makes it feel like something other Ottawa suburbs only pretend to be. For years, that employment anchor was not just a feeling, it was a genuine financial buffer. The Kanata North Business Park is one of the largest technology employment clusters in Canada. When the people writing the paychecks are local, the housing market underneath them carries a resilience that pure bedroom communities simply do not have. Here is what changed, and it changed faster than the market has priced in. The tech sector contraction that started in 2022 and ran hard through 2023 hit Ottawa's cluster in ways the national headlines underreported. Shopify, headquartered in Ottawa and genuinely woven into the cultural and economic fabric of Kanata, shed over 10% of its global workforce across multiple rounds of cuts. It was not one announcement and done. It was a slow bleed that took 18 months, and it touched every coffee shop, every gym membership, and every mortgage renewal conversation in the surrounding postal codes. Smaller firms in the business park followed the same pattern with less media coverage and the same financial consequences for the people holding leases and mortgages nearby. Then the work-from-home reversal hit. The dynamic that initially sent suburban demand soaring started unwinding as employers pushed hybrid and in-person mandates. The Kanata employment anchor, the single thing that separated this suburb from every other one on this list, became softer, precisely when the mortgage renewal cycle needed it to be strongest. The infrastructure liability underneath all of this dates to amalgamation in 2001, when Ottawa absorbed a capital replacement debt for Kanata's 1980s and 1990s era infrastructure that has been deferred quietly ever since. Exposure rating is moderate to high. The reputation is stronger than the foundation currently justifies. Orleans is Ottawa's East End suburb, and it carries a demographic profile that makes it uniquely vulnerable to the specific debt mechanics we are tracking. Not because the community is weak, but because the buyers who built the peak market there were already stretched before the rate environment changed, and stretched does not leave much room for what is coming next. Orleans went through an intense construction and appreciation cycle through the late 2010s and peaked hard in 2021. If you were buying in Orleans at peak, the odds are good that you were a first-time buyer or a young family who had watched the market climb for 3 straight years and made a decision that felt like now or never. That is not a criticism. That is what the market did to an entire generation of buyers across this country. It manufactured urgency and then handed you a variable rate mortgage as a reward for responding to it. The consequence is measurable. The peak era mortgage holder in Orleans is carrying, on average, more debt relative to household income than peak buyers in higher income markets. The margin for error is thinner. The buffer between a manageable payment and a distressed sale is narrower. The external pressures, renewal rates, property tax increases, and stagnant resale values are not thin. They are substantial, and they are on a schedule. Orleans also has a transit problem that has graduated from frustrating to structurally damaging. The light rail transit extension to Orleans has been discussed, planned, revised, and discussed again for so long that it is genuinely difficult to say with a straight face when or whether meaningful rapid transit will arrive before the infrastructure replacement cycle on existing roads and sewers forces a tax reckoning that reprices carrying costs for every household in the community. The Francophone community in Orleans is a genuine cultural asset. The cohesion is real. The identity is real. I say that without any sarcasm at all, which, if you have watched this channel for any length of time, you know is not something I say lightly, but community cohesion does not offset municipal debt mathematics. I wish it did. Exposure rating, high. Demographic leverage, transit uncertainty, and infrastructure deferral are compounding in real time. Stittsville is the suburb that got caught in the worst possible position in the Ottawa real estate cycle. And the reason it got caught there is actually a story about how affordability works as a trap when the infrastructure underneath it has not caught up to the price tag above it. Through the 2000s, Stittsville was rural enough to be genuinely affordable. That was not an accident or an oversight. That was the value proposition. Buyers came here explicitly trading location for price. Longer commute, quieter street, more land, lower number on the purchase agreement. That is a legitimate trade and a rational one. And for a window of time, it worked more or less as advertised. Then the rural to suburban transition happened, and it happened fast. The fields around Stittsville started filling with subdivisions. The price of land followed the demand curve upward. Buyers who had purchased on the premise of an affordable rural community found themselves, within a few years, holding a suburban-priced mortgage on a lot that was still being serviced like a rural property. Private wells, septic systems, the infrastructure of a village attached to the carrying costs of a suburb. The municipal water and sewer extension eventually came, and this is the part that does not get discussed at closing. That extension was not free. It was financed. The debt service obligation created by bringing municipal water and sewer infrastructure to Stittsville is real, it is documented, and it is not yet fully reflected in current property tax rates. That last part is the critical detail. The repricing is not a possibility. It is a schedule. The City of Ottawa's capital plan points to incremental tax adjustments running through 2026 and 2027. As that infrastructure debt obligation works its way into the rate structure. What that means in plain language is this. Stittsville property owners are currently paying a tax rate that does not yet reflect the full cost of the infrastructure servicing their homes. When it does, they will be paying urban tax rates for a community that still does not deliver urban amenity levels. That gap between what you pay and what you get is not a minor inconvenience. That is a dangerous valuation gap, and it is closing on a published timeline. Exposure rating, very high. The infrastructure transition debt is underpriced into current tax rates, and the repricing is not a maybe. It is a when. Riverside South. Riverside South is one of Ottawa's newer master-planned communities, which sounds like a compliment. It is not. Master-planned means the developer designed the community layout. The developer negotiated the development charges, the developer built the show homes, and the developer's marketing team named the parks after things like heritage, legacy, and harmony. The developer does not live there. Riverside South was sold as a premium South End community with a future LRT connection that would make the commute manageable. The Trillium Line extension to Riverside South opened in 2023 after years of delays and cost overruns. Ridership has been below projections. The operating cost of the extension is being carried by the city's transit budget. The development charges that were supposed to fund the infrastructure build-out were negotiated in a different interest rate environment, and they do not cover replacement costs at current construction pricing. The homes in Riverside South are new enough that buyers feel protected, and this is the trap. New construction feels safe because nothing has broken yet. But the municipal debt that funded the infrastructure those homes sit on is already on a repayment schedule that was modeled at interest rates and tax revenue projections that no longer reflect reality. Exposure rating is moderate to high. The newness is a psychological buffer, not a financial one. Findlay Creek. Findlay Creek might be the most quietly dangerous suburb on this list, and I say quietly because it does not get the same attention as Barrhaven or Orleans, which means the warning signs have not received the scrutiny they deserve. Findlay Creek is a southeast Ottawa development that grew rapidly through the 2010s and peaked in 2021, with detached homes regularly exceeding $650,000. The community has good schools, well-maintained streetscapes, and the kind of visual polish that makes buyers feel confident. What is underneath that polish is a stormwater management system that was designed for the development density projected when the community was planned, and not for the density it actually reached. Ottawa's urban boundary pressures push developer density higher than original infrastructure designs accommodated. The stormwater ponds in Findlay Creek are already operating above design capacity in heavy rainfall events. Climate pattern changes have produced more frequent heavy rainfall events in the Ottawa Valley than the infrastructure was designed to manage. When stormwater infrastructure fails, it does not announce itself with a press release. It announces itself with a flooded basement, an insurance claim, and a neighborhood reputation that takes years to rebuild and costs real money in depressed resale values in the interim. Exposure rating, high. The infrastructure undersizing is documented and the climate exposure is real. The debt map, what the numbers actually say. Let me put some actual numbers on the table, because this is the part where the video either becomes real for you or it stays abstract. I need it to be real. The City of Ottawa's 2023 Asset Management Plan identified an infrastructure funding gap of approximately $3.2 billion over the next decade. That is the difference between what the city needs to spend to maintain its existing infrastructure at a state of good repair and what the current tax and transfer revenue envelope actually produces. $3.2 billion. In a city of roughly 1 million people, that is approximately $3,200 per resident, or closer to $9,000 per household, of unfunded infrastructure liability that has to come from somewhere. It comes from one of three places. Property tax increases, reduced service levels, or additional debt, which is just a property tax increase with a delay attached to it. The City of Ottawa approved a 3.3% property tax increase for 2024. The capital plan models further increases through 2027 at rates that, when compounded, represent a meaningful increase in carrying costs for every homeowner in the suburban fringe communities we have been discussing. Here is why 2027 is the specific cliff edge rather than some other year. 2027 is when three separate financial pressures arrive at the same time. First, The 5-year mortgage terms taken out at peak pricing in 2022 come up for renewal at rates that are materially higher than the original purchase rate, even if rates have moderated somewhat from their peak. Second, the capital replacement schedule for first-generation Barrhaven, Orleans, and Kanata infrastructure reaches its most acute phase, forcing either tax increases or visible service deterioration. Third, the federal housing policy environment that has been propping up demand through immigration and first-time buyer incentives is scheduled for reassessment, and the political appetite for sustained intervention is genuinely unclear. When mortgage renewal shock, tax increase, and demand-side policy uncertainty arrive at the same address in the same year, the buyer who needs to sell into that market faces a very different price than the one their most recent assessment suggested. 48% is the number we put in the title of this video. Let me be precise about where that comes from. It is not a number I invented. It is a composite drawn from comparable suburban correction events. The Phoenix, Arizona suburban market corrected 56% from 2006 to 2011. The Outer Ring Toronto suburban markets have already corrected between 25 and 35% from their 2022 peaks in nominal terms and further in inflation-adjusted terms. The 48% figure represents a scenario where Ottawa's suburban fringe experiences a correction in line with mid-range comparable events, not a catastrophic outlier. It could be less. I genuinely hope it is less, but less is not zero, and the people I'm worried about are the ones who are modeling zero. Who gets hurt the most? The first group is the 2021 and 2022 buyer. This is the person who purchased at or near peak pricing, likely with a variable rate mortgage or a short-term fix that is already renewed once at a higher rate, and who is now carrying a home that is worth less than they paid for it in a market where selling means crystallizing a loss they were told would never arrive. These buyers were not reckless. They were told by every institution around them, the bank, the agent, the developer, the federal government, that Canadian housing only goes up. They bought into a consensus. The consensus was wrong, and they are holding the bill. The second group is the investor class. From 2019 through 2022, Ottawa's suburban markets attracted a meaningful wave of small-scale real estate investors. Single-property landlords, basement suite converters, and multi-unit holders were told that Ottawa was a stable government town, immune to the volatility of Toronto and Vancouver. Ottawa is a stable government town. That stability does not extend to municipal debt mathematics or infrastructure replacement schedules. The investor who bought a Barrhaven semi-detached as a rental in 2021 is now dealing with a carrying cost that does not clear rent at any rate a tenant in that market will pay, a management headache that no one talked about at the investment seminar, and an exit that requires finding a buyer in a market that is moving in the wrong direction. The third group is the one I find most troubling to talk about. The retiree who extracted equity from a paid-off inner-city home to move into a suburban new build because the house felt too big, and the suburb felt like a fresh start. These are people who converted a paid-off asset into a leveraged position in a market at its peak. They are not carrying catastrophic debt in every case, but they are sitting on a principal residence in a market that is on this list, and the cushion they believe they had built over 40 years of homeownership is more exposed than they know. What smart Ottawa buyers are actually doing. If you are in Ottawa or watching from somewhere else in Canada where the same suburban debt pattern is playing out, here is what the buyers who are paying attention are actually doing. Not what they are saying they are doing. What they are actually doing. Move one. They are buying inside the Greenbelt. The National Capital Greenbelt is the geographic moat that separates Ottawa's inner urban fabric from its suburban fringe. Properties inside the Greenbelt, older stock in Hintonburg, Wellington West, Old Ottawa South, Westboro, and Vanier are not immune to correction. Nothing is immune to correction. But they carry a fundamentally different risk profile. The infrastructure underneath an inner-city Ottawa neighborhood was built in 1950 or 1960 and has been maintained, rebuilt, and upgraded continuously for 60 years. It does not have the same replacement cliff that suburban fringe infrastructure is about to hit. The buyer pool is broader, the transit access is real, and the land value has a scarcity argument that suburban land does not. Move 2. They are buying homes built before 1985. I will explain why that specific year matters. 1985 is roughly the cutoff before which Ottawa residential construction used materials and trade standards that have already proven their durability. A brick fourplex in Centertown, built in 1968, has been stress tested through 60 years of Ottawa winters. You know what you're getting. The deferred maintenance is visible and priceable. The hidden liability profile is fundamentally different from a Riverside South townhome with a municipal debt obligation baked into the tax structure and a stormwater system operating above design capacity. Move 3. They are asking one question before any offer, and this is the question. What is the 5-year capital tax projection for this ward? The City of Ottawa publishes ward-level capital plans. Most buyers never look at them. The ones who do can see in black and white what infrastructure replacement is scheduled in their prospective neighborhood and how the funding gap is expected to be closed. If the answer is a combination of debt and tax increase, you are looking at a carrying cost that will rise on a schedule you did not negotiate. Price it in or walk away. Those are the two rational options. I will say this clearly. I am not telling you that Ottawa's suburban communities are worthless or that the people who live there are making a mistake by staying. Communities are more than balance sheets. Barrhaven has real people with real lives and real community attachments. So does Orleans and Kanata and every suburb on this list. What I am telling you is that the financial foundation those communities were built on has a structural weakness that is on a documented timeline, and that weakness has not been honestly communicated to the people who are most exposed to it. Here is the pattern that ties everything on this list together, because it is the same pattern we come back to on this channel every single time. The developer who designed Findlay Creek's stormwater system did not build his retirement home in Findlay Creek. The city planner who approved the Barrhaven subdivision density targets does not commute from Barrhaven. The mortgage broker who told the buyer from 2021 that Ottawa real estate was a guaranteed store of value has already collected his commission and moved on to the next file. The only person who will be standing in that suburb when the infrastructure replacement bill arrives, when the tax notice lands, when the renewal rate reprices, and when the resale market reflects what the debt map was showing all along, is you. That is not an accident. It is the product. The builder's incentive is to sell the house. The developer's incentive is to sell the lots. The city's incentive is to expand the tax base and defer the replacement cost to a budget year that is someone else's problem. Every single incentive in the system points away from telling you the truth about the debt that is underneath the subdivision you are about to buy into. There is a term I want you to take away from this video, not builder grade, though that applies to the physical construction. The term I want you to remember is infrastructure debt shadow. Every suburb on this list is sitting in the shadow of debt that was issued to build it and that has not yet been fully repriced into the carrying costs of the homes above it. When that shadow catches up, and it catches up on a schedule, not a maybe, the repricing is not gentle. 48% is the number we put in the title. The number could be 30%. It could be 35%. In a scenario where interest rates drop significantly and federal housing policy intervenes aggressively and the capital replacement schedule gets another round of deferral and Ottawa's population growth exceeds projections, the correction could be shallower. But here is the thing about a 30% correction when you bought at peak with 5% down. At 30% down, you are still underwater. The depth of the water is the only variable. The fact that you are underwater is not. check the infrastructure age, check the capital plan, check the tax trajectory, and if the person selling you the house has never mentioned the words infrastructure, debt shadow, ask them why. Their answer will tell you everything you need to know about whose interests they are actually serving. I am Alexander. This is Broken Canada. Next week, we are going inside the actual construction documents for a 2022 Ottawa new build. And I'm going to show you what builder grade means when it is your foundation, your insulation, and your HVAC system. That one is worse than this one. Subscribe so you do not miss it.